Hello, my name is Christopher Charlton. It's Friday the 12th of March around 3 o'clock and I'm here to give you the weekly review from Centre Asset Management. The US State Department has been forced to apologise to the government of Libya for derogatory remarks made by their spokesman PJ Rowling over the recent dispute between Libya and Switzerland. This originated from the arrest of Colonel Gaddafi's son, Hannibal, for beating up two of his employees in his hotel room in Geneva. It has now escalated into the colonel calling for a jihad or a holy war against Switzerland. So it was with trepidation that I visited Zurich this week, expecting to see fear on the faces of the population and the army out in the streets. As you know, the Swiss army is famous not only for its knife, but also for its bicycle. Well, I was amazed. The city was its normal, calm and serene self. People in good humour. It seems that despite his $140 billion in assets, the colonel cannot find anyone really to take him seriously anymore. HSBC announced today that the personal information from over 24,000 of its clients has been stolen from a bank's computer. Is this really a problem nowadays? The German government seems to have recently redefined the theft of personal and private data from banks' computers as a business opportunity rather than a crime. So I really don't understand what the fuss is all about. Turning to the markets, in China we saw strong inflation numbers and economic statistics that show an economy that is surging ahead. CPI was up 2.4%, a 16-month high. Industrial production up 20%, imports and exports up 46%, M2 up 25%. Although the authorities are downplaying the numbers, citing seasonal influences, the odds are high that we will see a more aggressive tightening stance in the near future. In our view, this will put downward pressure on the Chinese stock market in the coming months, and other markets will follow. If you look at recent correlation between the S&P and the Shanghai index, recent actually since mid-2007 is when this started. You can see this correlation quite clearly here. There seems a very good chance if we do see the Shanghai market moving down that it will influence the other markets as well. The issue is inflation, and we are seeing a few signs, although we're seeing no real signs of inflation in the Western world, a more deflationary environment. In Asia, we are seeing inflation starting to pick up. Right? The bond market seems to look as if it wants to turn lower in expectations of higher rates to come. We have two important events coming up this week. One is how Schumacher gets on at the Grand Prix in Bahrain on Sunday. This was a picture taken in 2006. I think it was the last time that he drove there. And the other is that the US Federal Reserve Open Market Committee meeting on Tuesday. Up till now, the markets have been driven by the wording of Ben Bernanke that central banks will keep interest rates exceptionally low for an extended period of time. This week, the Fed ended its short-term liquidity programs established at the height of the financial crisis and will wind up its 5-year facility in June. There's been speculation that the Fed might even raise rates on Tuesday. I'm sceptical of that, with unemployment remaining stubbornly high, but there may be a change of wording. So, this is the chart of the S&P. We could see, if we see a change of policy from the Fed on Tuesday, we could see the market turn down quicker than expected. If not, we will probably have this scenario, where we still see a move up, maybe another 5% before turning down. The spectre of inflation and higher rates will pressure the bond markets, and at some point the stock markets will follow. Here's also a chart of the FTSE for UK, people in the UK be interested in this, and there again we see maybe up to 6,000 and then down there. So a potential 5% move up, but maybe then a 20 to 30% move down. So we do not recommend stocks and equities at this level. Okay, let's have a look at the currency markets. We've been tracking the euro-dollar and the sterling in the recent weeks, so we'll stay with them today. Euro-dollar will be in this range between 134.5 and 138 since early February, and we're approaching the top of the range again today. As we said last week, we believe this to be a consolidation, a fourth wave in Elliott wave terms, and once it is over, we will resume the downtrend. So the optimal target of this fourth wave is 138.5, and we regard this as a selling opportunity. Here's the wave count: 1, 2, third wave, fourth, and then a fifth down, back down towards 130. For the pound, the scenario is very similar, maybe up to 153.5 and then down towards 140 for the pound. The euro sterling we were tracking as well. We still have no change of opinion here. We reached the 91 level again this week and backed off a bit there. We're back up towards it again now, and we expect it to move slowly towards 94. If and when we get there, we will review the situation then. Of course, Greece and the European problem is still the major issue concerning the financial markets. With all the turmoil and discussions over debt and fiscal problems in Europe, the uncertainty of the UK elections, the fate of the yen, will China float, and so on, one commentator came out today, this week and said, well, at least the markets are rallying, meaning the equity markets. I wondered what he meant by this, as if this was a panacea for all problems. Surely one of the root causes of the current crisis is the concept of growth at all costs. The policies of credit creation over the last 30 years resulted in asset growth bubbles that in turn changed the face of the responsible bankers into robber barons and normal citizens into gamblers on their families and homes. The perfect example of this is Greece, which only reflects what is going on in other countries around the globe. Population lived beyond their means, fed by greedy bankers throwing every sort of temptation at them, and the politicians became corrupt as they could no longer control their own excesses. The people are on the street demonstrating like spoilt children that it's not their fault, but the government's. They are all to blame. We are both to blame. But is it not the system behind this that enabled all this to come about in the first place that is really at fault? Yes, the stock markets are rallying, but do the street demonstrators in Greece really benefit from this? Who actually benefits apart from the financial industry and the few who actively participate in the stock markets? I realise that the UK is more equity prone than, let's say, Germany, but that's not my point. My point is the governments still believe that they can solve a problem created by a massive overcreation of credit by creating more credit and pushing asset prices higher. I believe they will invariably fail. In the meantime, Europe is being pushed towards a more federalistic union, whether it likes it or not. This is worrying, but probably inevitable. One of the main concerns of the loss of is the loss of national identity. But, that said, after 50 years of the common market, the Germans still eat bratwurst, French eat snails, and the Brits play cricket. So, after all the depressing talk about responsible fiscal policies and debt reductions, I hope that Greece will maintain its national characteristics, those reflected so well by the final scene in Zorba the Greek, where after the disaster of their business venture, they sang, drank, and danced on the beach. I'll leave it like that and wish you a very good week.